Hello and welcome to another video on how to secure yourself financially. So in today's video, I'm going to jump straight forward to the MD&A, this management and analysis of financial conditions and results of operations. So after I went through all of this section, okay, where the SEC, the Security Exchange Commission, make this website for beginners uh, to starting to understand basic part of financial statement. So if you're able to read nutritional labels or read baseball box score, you can learn to read the basic part of accounting and the financial statement. And if you can follow the recipe or apply for a loan, you can learn the basic of accounting. And the basic are difficult. So much like on a CPR course, this cardiopulmonary resuscitation courses that teach you the basics, this section focus is on that. So it won't train you to be an accountant, much like a CPR course won't train you to be an cardiac doctor. But it can help you to give some confidence, especially when you're able to see a set of financial statement and make sense of that. So the TLDR, the too long didn't read, is, well, this is financial statements show you the money, and there are four types of them. You have balance sheets, income statement, cash flow, and the statement of the shareholders. So the balance sheets show what a company owns and what it owes at a fixed point in time. The TLDR is this is a snapshot of company assets, liabilities, and shareholders' equity quarterly or annually. The income statement show if a company made a profit or not, so how much a company spend or earn producing its good and service. The cash flow show is the exchange of money between the company and the outside world. So the bottom line indicate is the net increase or decrease of this cash while reusing some information from the balance sheet as the sorry, some information from the balance sheet and from the income statement. And the statement of the shareholder, which is something that they don't describe here, okay, at least not in detail. It is the change, or it shows the change in interest over time of the shareholders. So after I look also at the cash flow statement, right? That this statement focus on that this statement focus on the to look at the cash flow from one of these activities, operating, investing, and financing. So the operating are can be break down into common operating assets and liabilities. And this first part, what it does is analyze the net income from the income statement and conciliate with the total amount of cash that was used or perceived from operating activities. So most common operating assets, most common operating activities, as I mentioned before, can be broken down into uh, operating assets and operating liabilities. Operating assets such as inventory, accounts receivable, prepaid expense, property, plant, and equipment, intangible assets such as patents, copyright, trademarks, trade secrets, goodwill, customer relationship. Investment in affiliate is another common operating asset, such as investment in joint ventures, equity investment, limited partnership, associate, as well as the cash and cash equivalent, such as money market funds. And when it comes to common operating liabilities, we have accounts payable, accrue expense, defer revenue, income taxes payable, whether it's corporate withholding or sales taxes, short-term borrowing, whether it's for the bank or a business or line of credit. I'm sorry, line of credit, mm, notes payable, which is an agreement between the borrower and the lender that is that outline all the conditions of that loan, okay, such as banks, payables or notes payable from banks, from private equity or other business like private equity or venture capitalists, as well as uh, trade payables with your suppliers and vendors, individuals. So also I look at the warranty obligations, and just this is just to explain is the most common operating liabilities that impact the cash flow, right? And then the investing activities that it generally involves the purchase of long-term assets, such as property, plant, and equipment, uh, intangible assets, investment, leasehold improvement, and then financing activity. So with financing activities, well, this focus on how a company is raising funds from investors and pays back directly through capital markets, because this financial activity, okay, helps investors to see how often a company is raising funds and where the money is coming from. So if a company cash flow comes from its operations, most of the time that's a good sign of a business. That's a good sign of a good investment. However, if a company is constantly relying on taking out of debt and issuing equity, that might not be a good sign for this. Again, this is just a so oversimplification of the topic. So this activity involves primarily, well, raising funds from vendors, raising funds from investors and creditors, as well as repaying debt and paying debt or paying dividends to investors or repaying to investors. So you have, for example, issuing equity. This is a form of financing, especially when a company go public for like initial public offering in an IPO. So issuing equity, issuing debt. The company can issue some financial debt instruments such as bonds, debentures, or bonds, debentures, and notes payable, repaying debt, repurchasing stocks, leasing. This is just a couple examples of financing activity. And then I look at the footnote, which is something important to do because it paired with some information that some of the highlights are significant accounting principles or significant accounting policy and practice. So how these companies are adhering to the accounting policies, whether it's from the GAAP, the generally accounting accepted principle on the US, or the international financial reporting standard, where this was created because as the company grows and now become multinational, so we need the accountant or the accountants need to find a way to create transparent, easily shareable, and consistent financial reports or financial statements that can be easily shared across the globe, according to Investopedia. So, yeah, significant account practice and policies. Significant accounting policies and practice. Income taxes talk about in fine grained detail about the information, okay, about the local, state, federal, and foreign taxes, as well as the deferred income taxes, pension plans, and other post-retirement programs. This section discusses in detail about this. Apple discussed that much more from their Q10. Thank you. Thank you, Amazon, and then thank you, Apple, right? The SEC feelings and the Amazon feelings, quarterly results. That's right. So this thank you, which is a form, that form, thank you, like this. We talk about the quarterly report. So these forms, quarterly report percentage, and the same for this. There you got it. So the quarterly report percentage. So all of them they following is this particular form, right? So in the footnotes or below to the financial here, they talk about things like this. The notes to condense consolidated financial statement. The summary of the significant accounting policies. So if I take a look at now at the Amazon, notes to consolidated financial statement. This is what they describe here. Accounting policy and supplement disclosures. So in theory, they're supposed to talk about is the pensions and post-retirement program, right? Commitments and contingencies. But this is where they define things like that. Commitment and contingencies. So pension, the word pension is not even here. Retirement. Retire. They don't talk about that. Pension. Post. Employment. Or employment. Because to me is something interesting that this company doesn't talk about that. Commitments and contingencies. And there's a lot of people that, because they fear other contingencies, because they fear they will get out of the system, stockholders' equity, stock repurchase activity, stock award activity, income taxes, segment information, and then they jump here to managing the discussion and analysis of that. And this is something interesting to me that they don't talk about. You know, that they don't talk about the pension and other post-retirement programs, which is something, according to the SEC, that they must discuss in that. Why? Because, well, this is these are plans, okay? These are plans and pension and any other post-employment benefits programs that must discuss about the costs and assets, as well as if those funds are over or under funded. And then you look at the stock options on here in the financial statement, the last section here of the financial statement, or the consolidate, not to condense, consolidate financial statement. So here they're supposed to talk about that basic of presentation preparation, earning per share. They talk about that, the stock options, as well as the revenue, then financial instruments, revenue, financial instruments, derivative instruments and hedging, foreign exchange risk, interest risk, accounts receivable, income taxes, death, shareholders' equity, benefit plans. This is when they describe it here. Okay. Benefit plans, Apple described this. What actually does it mean this? Restricted stock units. Restricted stock unit, a form of compensation issued by an employer to an employee in the form of company share. Okay. It's a type of compensation. And this is a type of compensation. A form of compensation issued by an employee to an employee in the form of company shares. Mm-hmm. Mm-hmm. Okay. And then I look here the commitments and contingencies. Okay. Commitments and contingencies. Unconditional purchase obligations and contingencies. Mm-hmm. Is commitment and contingency the same for commitment and contingencies? If I ask, for example, ChatGPT here, is commitment and contingency pension plans in a at the footnote on a financial statement? Is commitment and contingency plans at the footnote in a financial statement? Is commitment and contingencies pension plans at the footnote in the financial statement? Contract obligation, potential liability, and other conditions. However, it's important to note that accounting standards okay, so it's not. All right. So the point here is that I don't see right now anything discussing about pensions and post-retirement programs. And when I try to look at the word pension, they don't even the pension. They talk about suspension, but they don't talk about pension on any post-retirement program. Post or retire. There you got it. Retirement obligations in commitment and contingencies, including includes asset retirement obligations, discretions. No, this is something interesting, not that interesting. But in any case, yes, the stock option, which is another section here on the footnote. So this is stock options. It's a form of compensation from employee to from the employer to employees, okay, to do that. If we take a look at the stock option definition, that is a financial instrument. When we talk about financial instruments, is no more than an asset, or can be also seen as a package of capital that can be traded. So this stock options is a financial instrument that give the owner the right, but not the obligations, to purchase an asset and a given upon price and date. So you have two type of options: put and calls. Puts are bet that the stock will fall, whereas calls, which is a bet that stock will rise. And because of this options, is a type of financial instrument known as derivatives, meaning their worth are based on an underlying security or assets. Important, very, very important thing here. So the value of the worth of these stock options, uh, because this is known as a derivative, this stock option, it worth based on the underlying security or assets, whether it's an asset, a group of assets, or benchmark. But it's important to recognize this, that those stock options completely, right? That those stock options are financial instruments known as derivatives, and this means their worth is based uh, on an underlying security or asset. That's what it is. So very, very important to understand that distinction from this stock option. Yes, it's a financial instrument known as derivative, which means that their worth are based on a derivative or an underlying security or asset. So with that, right? Then I read the NDA, which is the management discussion and analysis of financial conditions of and result of operations. That is an opportunity for the management to tell what the financial statement show and do not show. So it's also it also describes important trends and risk that has shaped or that has shaped the past or are reasonably likely to shape the company's future. So this section it is intended to help investors to see the company through the eye of management. And it is also very so this section is intended to help investors to see the company through the eye of the management. It also intends to provide context to financial to yeah, it also intends to provide context for the financial statement and information about the company earning and cash flow. So by reading about this NDA, if I take a look at this, after I look at the financial statement here, the cash flow operations, income, and the balance sheets, okay. Then I look at the notes to consolidate financial statements, which is the footnotes, and the management discussion and analysis. So here what we have is the management discussion and analysis of financial conditions and result of operations. That is describing a forward-looking statement, critical accounting estimate, inventory income taxes, liquidity and capital resource from operating activities, investing and financing. This is from Amazon, all of this information. Results of operations. We have organized, okay. Again, this is an opportunity to tell investors, okay, an opportunity for investors, as described here. It intends to help investors to see the company through the eye of management. And it also intends to provide more context about the financial statement. Results of operations, overview and net sales, North America, international AWS. Year-over-year percentage growth decline. In North America, even though they growth in North America, but they decline in international, as well as the AWS. And the consolidate is this. Year-over-year percentage growth excluding the effect of foreign exchange. North America, international AWS. And the consolidate. And net sell mix. North America, international, and AWS. International sales increased 1% in quarter one 2023 compared to the comparable prior year yesterday. Mhm. The sales growth primarily reflect increased unit sales, primarily by third-party sellers, advertising sellers, and subscribing service. Increased unit sales were driven largely by our continuous focus on price, selection, and convenience for our customers, including from our shipping offers. International sales increased 1% in quarter one in quarter 2023 compared to the comparable prior year period, primarily due to the increased unit sales. Compared to the comparable prior year period. So if I take a look at the 2022 like this, or 2021, the first Q quarter earnings, and here from 2022, and if I go back to the management, the MDA, okay, and when I look here at that, sales increased 7% in quarter one compared to the comparable prior year. International sales decreased 6%. Exactly, when they have this, it's a decrease. 6% compared to the prior year in 2022. Interesting. So if I take a look now at the 2021 Q1 earnings, all right, and the management is MDANA, and I take a look at their results of operation. Even though those companies never lost money, 2020 and 2021, at least not Amazon. At least not Amazon. And thank you. Here in 2020, so navigate to that. Even though those companies never lost money, at least Amazon never lose money. Well, it seems yes, it does. But what is this? Operating income loss. In North America, operating income decreased 4.4 billion in quarter one 2019 to 4 billion in quarter one 2020. We believe that operating income loss is more meaningful measure than gross profits. Operating income is a more meaningful measure than gross profit and gross margin to the diversity of our product category and service. The decrease in North America operating income is absolute dollar in Q1 2020 compared to the comparable prior year. Exactly. We expect operating income to be reduced through at least Q2 2020 due to COVID-19 related increase to fulfillment costs and cost of sales as a percentage of net sales. The increase in AWS operating income in absolute dollar compared for that. So they lost in operating income $400 million. Jesus, $400 million. God damn it. So by take a look at this, looking at all of this, right? And the TLDR of this is that the NDA is a way to provide, it's a way to help investors to see through the management eye how this company, so important trends, risks that have shaped this company or will likely shape the company's future, as well as provide more context of the financial statement, like this. Yep, yep, totally, totally. Okay. And then I look at the financial statement ratios and calculations. Okay. So, uh, just to recap here, just to recap here, the MDA is just a way or helps investors to see the it helps investors to see the company through the management eyes and providing these important trends that have shaped the company past or likely shape the company's future, as well as provide more context of the financial statement. Okay, all right. And then I look at the financial statement ratios and calculations. So you have probably heard people banter around phrases like PA ratio, current ratio, and operating margin. But what does these terms mean and why don't they show up on a financial statement? Listed below are just some of the many ratios that investors calculate from information on financial statement and then use to evaluate a company. Okay. These are ratios these are ratios that investors use to calculate and evaluate information of the financial statement of a company. As a general rule, desirable ratios vary by industries. If a company has a debt to equity ratio 2 to 1, it means the company has $2 of debt for every $1 shareholders invested in the company, meaning that the shareholders, instead of owning $1, they only have 0.5 or 50 cents. Yeah. In other words, the company is taking on debt at twice the rate that its owner are investing in the company. Inventory turnover. So this is one ratio, right? Again, financial statement ratios and calculations are a set of ratios and calculations that investors use to evaluate a company. Interesting. Okay. 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 If a company has a debt to equity ratio to 1, it means the company has $2 of debt for every $1 shareholder invested in the company. Sorry. The other is inventory turnover ratio, the cost of sales divided by the average inventory for the period. If a company has an inventory turnover ratio 2 to 1 of the cost of sales, so how much costs the cost of sales and average inventory for the period? It means the company inventory turned over twice in the reporting period. So it means that the company inventory turned over twice in the reporting period. What actually does it mean this? Describe what the following text delimited by triple backticks. Describe what the following text delimited by triple backticks mean. What the hell? Let's break down the explanation. The first line defines the inventory turnover is calculated by dividing the cost of sale. The cost of sale refers to the expense associated with production, purchasing goods the company sells during the specific period. The average inventory for the period represents the average value of inventory a company holds during the same period. The average value. Okay, the average value that an inventory. To calculate the average inventory, you typically add the beginning inventory value at the ending inventory value and dividing the sum by 2. The second phrase providing as an interpretation of the inventory turnover ratio. If a company turnover ratio is 2 to 1, it means that the company investor has been sold and replaced twice during the report period. Has been sold and replaced twice than the reporting period. This indicates that a company is efficiently managing its inventory and selling products related quick. And it is exactly. It indicates that a company is effectively managing its inventory and selling products relatively quickly. So if that ratio is greater, if that is a positive ratio, okay, or a ratio above 1, that's a good sign of this because this company is replacing. Okay, the company is replacing. Okay, the company is effectively managing its inventory and selling product relatively quickly. Mhm. And then I look at the operating margin, income from operation slash net revenue. So that'll be all for this video. And with that, take care. Bye bye.